There's this massive engine that powers the entire global economy. It works 24 hours a day, affects almost everything we buy, and yet most of us never even see it. Today, we're going to pull back the curtain on that engine, the global foreign exchange market. Let's get into it.
First things first, we have to talk about the scale because it's just staggering. Look at this number. That's $6.6 trillion. That is the amount of money traded on the foreign exchange or FX market every single day. That's based on 2019 data from the Bank for International Settlements. To put that into perspective for you, it absolutely dwarfs all the world's stock markets combined. It is without a doubt the biggest financial market on the planet.
So, what does this gigantic market actually do? Well, at its core, it performs three really essential functions. First, it lets us transfer purchasing power. It's what allows a company in Japan to buy parts from the US or for you to buy something online from Europe. Second, it provides credit. See, international trade can be slow, and the FX market helps finance things while goods are in transit. And third, it helps businesses hedge their bets and minimize the risks that come from currency values bouncing up and down. It's basically the essential plumbing for all of global commerce.
Okay, so that's the logical next question, right? Who are all the people and institutions sloshing these trillions around every day? Well, a market this huge has a really diverse cast of characters, and they all have their own reasons for being there. Let's meet the 5 main groups of players.
First up, you've got the dealers. Now, these are the big banks and other major trading firms that act as market makers. Think of them like the wholesalers of the currency world. They're always ready to buy or sell major currencies, and they keep a big inventory on hand. They make their money on the bid-ask spread. That's a tiny little difference between their buying price and their selling price. It's a game of huge volume and razor-thin margins.
Next up, we have what are called commercial transactors. And honestly, this is probably where most of us would fit in. We're talking about everyone from giant multinational corporations buying supplies overseas to investors moving money around and even tourists like you and me, swapping some cash for a vacation. The key thing here is, for this group, the FX market isn't about making a profit. It's just a tool, a necessary step to get something else done.
Now we get to the profit seekers. Speculators and arbitrageurs are in this market for one reason: to make money. Speculators are placing bets, pure and simple. They're betting that a currency's value is going to go either up or down. Arbitrageurs, on the other hand, are like super fast shoppers. They look for tiny, fleeting price differences for the exact same currency in different markets, and then try to buy and sell at the same time to pocket that tiny difference. It's all about exploiting market movements for personal gain.
Central banks and treasuries are, well, they're a totally different kind of player. Their goal is not profit. They get involved in the market to manage their country's reserves or to try and influence the value of their own currency. And what makes them so unique is that they're often willing to lose money to achieve a policy goal, something a speculator would never, ever do. They're playing a completely different game.
And last but not least, you have the foreign exchange brokers. Think of these guys as the matchmakers. They don't actually buy or sell the currency themselves. Instead, they connect the dealers who want to trade with each other. They're the facilitators, the networkers, who help keep this huge, decentralized market running smoothly.
You know, the way all these players interact has been completely turned on its head over the past few decades. The modern era really kicked off in the 70s, but the real revolution, it's been all about technology. This timeline just gives you a little taste of that rapid shift, from a world of phone calls to the lightning-fast electronic market we have today.
And this right here shows you exactly what I mean. On the left, you're looking at the 1980s. The market was a club. Everything was done by telephone, between the big dealers, and if you were a regular customer, even a big company, you were on the outside looking in. By the 90s, things started going electronic. But, as you can see, retail folks were still kept at arm's length.
And then you have today. Just look at this. It's a completely different universe. Those old walls and barriers have totally crumbled. Now you have all these different platforms. Single bank systems, multi-bank portals, retail aggregators. They give pretty much every type of customer, from a hedge fund down to an individual trader, direct access to the whole world of trading.
So the most important takeaway here is that technology has totally democratized the foreign exchange market. That rigid two-tier system that separated the pros from everybody else, it's basically gone. And that's led to more transparency, better pricing, and way faster trades for everyone involved.
Okay, so we know who's trading and how they're trading. But what do these trades actually look like? Well, most of them fall into three main buckets, and it's all about timing. The most common is a spot transaction. You agree on a price right now, and the actual exchange happens in 2 business days. A forward transaction lets you lock in a rate today for an exchange that will happen sometime in the future. And then a swap is a little more complex. It's basically buying and selling the currency at the same time, but for 2 different delivery dates.
Now, to make any of those trades, you've got to know how to speak the language. This is what a standard currency quote looks like. Don't worry, it's simpler than it seems. The first currency listed, in this case the euro, is the base currency. It's always equal to 1. The second currency, the US dollar, is the quote currency. So the numbers tell you how many US dollars it takes to buy or sell 1 euro. The first number is the bid, what a dealer will pay you for it. The second is the ask, what they'll sell it to you for.
Okay, and quotes can be either direct or indirect, and this all just depends on your point of view. So if you're in the United States, a quote of $1.21 for 1 euro is a direct quote. It's the price of a foreign currency in your own money. On the flip side, a quote of 0.82 euros for $1 would be indirect. It really just all depends on what you call your home currency.
All right, let's zoom out and take a look at the big picture. One of the wildest things about the FX market is that it never, ever sleeps. It's a continuous 24-hour-a-day market. As the trading day is winding down in Asia, Europe is waking up and getting started. And as Europe closes, New York is in full swing. The baton just keeps getting passed around the globe. But where is all of this nonstop action actually happening? This chart tells the story pretty clearly. London is the undisputed heavyweight champion of the world, accounting for a mind-blowing 53% of all global currency trading. The United States is in a distant second place at 20%, followed by the big hubs in Asia, like Singapore and Hong Kong.
So what currencies are being traded? Well, let's be clear. It is the US dollar's world, and everyone else is just trading in it. The dollar is on one side of an incredible 88% of all trades. It's the king. The euro and the Japanese yen hold down the number 2 and 3 spots. But you got to keep an eye on the Chinese renminbi. Its slice of the pie has nearly doubled in just a few years, which tells you a lot about China's growing clout in the global economy.
And all of this brings us to one final thought. The FX market we see today has been shaped by constant dramatic change. From people on phones to complex algorithms, from an exclusive club to a global free-for-all. With technology moving faster than ever and the balance of economic power always shifting, the market of today is definitely not the market of tomorrow. Which begs the question, who and what is going to dominate it next?